Today we're talking about capital gains taxes. I mean, who doesn't love taxes? So, capital gains tax, first and foremost, is if you sell something and you make money on it, the federal government can sometimes tax you. And also the state and county and city too. So depending on where you live, it could be bad news and then worse news, or bad news and then not so bad news. So first thing that you need to know, federal government capital gains tax is 15% on long-term capital gains. How does that apply to real estate? Well, if you own a property and you have it as an investment property, or you have it over long enough that you've made more than $250,000 on your principal residence, you got to tune into another home happy hour where we're going to talk about the principal residence exclusion. But on a capital gains tax, it's going to be only on the gain. So people are like, how do I figure that? Most people make the mistake that they figure what they owe on the house, whatever they are getting from the sale, is taxable, and that's not actually the case. So what you need to do is you need to look up what you bought the house for. That's the base. Whatever you added in value to that house. Now, so if it's like I remodeled the kitchen, or I upgraded the furnace, or I added this brand new deck to the backyard, all those things are called capital improvements, and they add to the amount of money you've put into the property, and thereby they reduce your gain. So let's just say that you happen to buy a property for $400,000, and over the course of 20 years you put $75,000 in it. So now your capital improvements, your basis in that property is $475,000. If I sell it for $675,000, well, I have $200,000 of gain. Does that make sense? Now, this can be super complicated, and the first time I started studying this, I totally got it wrong. So we're gonna just add some math problems for you later so you can check your work. But no, seriously, it's a very complicated topic, and you're gonna wanna talk to a real estate professional. You're also gonna wanna contact your accountant, because there are ways to avoid being taxed on this, especially if it's an investment property. There's a thing called a 1031 exchange that we're going to talk about later in other episodes, so check that out too if you're going deep dive on the capital gains tax. But the things you should know are definitely call a professional before you sell, so you are not surprised, because once it's sold, there's nothing you can do about it. Before that, though, there's plenty that you can do about it. So, deep dive into taxes. Capital gains tax, you might not have to pay it if you're principal residence. If it's an investment property, you can avoid it with a 1031 exchange. And if you have to pay it, there are ways around paying the maximum. That's your tax class for today. And it was really nice of you to tune into our home happy hour. We'll see you next week. Take care.